Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis. Do you own your own business? If so, you probably already know that it's up to you to make sure that you have enough money to fund your own retirement. You can't count on anyone else to take care of it for you. Today, we'll be going over ways that you, as a business owner, can maximize your retirement savings. And if you stick around to the end, I will introduce you to a plan that will allow for you to put up to 6 figures away into your retirement account every single year. Let's dive in. All right, guys, welcome back to Taxes Made Simple. When you own your own business, you are responsible for planning for your own retirement. While salaried employees at big companies usually have the option of contributing to a company sponsor retirement plan, business owners, particularly small-based business owners, don't have that luxury. You have to come up with your own plan, whether that's just for you, if you're a sole proprietor, or if you have employees for them as well. Another thing that business owners have to contend with is that often they spend years reinvesting any extra money that they have back into their businesses rather than making contributions to their retirement plans. So they kind of start off behind people. By the time they get around to thinking about retirement, they realize that a regular IRA, even a regular 401k, may not cut it as far as allowing them to set aside enough money that they need for retirement. Fortunately, there are plans that allow for you to make catch-up contributions and some that allow for you to contribute way more per year than that of a standard 401k. And some of them even come with tax breaks for you as a business owner. So if you're a business owner who wants to know how you can maximize your retirement options, I think you'll find today's video to be very helpful and educational. So let's jump right in. You're probably already familiar with the standard 401k, which is probably the best known of the various retirement options out there. Most larger for-profit businesses offer their employees the opportunity to contribute to a 401k plan. As a business owner, you can offer a 401k plan to your employees and take advantage of it yourself. 401ks allow you to contribute up to $19,500 a year pre-tax with the option of a $6,500 catch-up contribution if you're older than the age of 50. That means you and your employees can reduce your taxable income by as much as $26,000 a year, and that may be a huge advantage for a business owner. For example, there is a tax credit available for business owners with 100 or fewer employees that are starting a 401k for the first time. You can also deduct any plan management expenses and any matching contributions that you decide to make as an employer for your employees. So there's some administrative legwork that has to be done with 401ks. You'll have to set up your company's 401k with a provider that will handle the record keeping, the investing, and the administrative work. And you'll want to make sure that that company can fully integrate with your HR department and your payroll providers to ensure that your employees' personal information and retirement contributions are accurate across all platforms. Now, that's the normal 401k. Let's talk about solo 401ks. What if you're a business isn't big enough to have any employees besides you? Can you still take advantage of a 401k? Yes, as a matter of fact, you can. And as long as you're self-employed and have no full-time employees, you qualify for a solo 401k. So a solo 401k, also known as an individual 401k or self-employed 401k, works a little bit differently than a standard 401k, but actually gives you the opportunity to save even more. The cool thing about this kind of plan is that you're allowed to contribute both as an employer and you can contribute as an employee, meaning you get to contribute up to $58,000 for 2021, twice as much as you could with a regular 401k. You see, as an employee of your business, you can contribute up to $19,500 for 2021 or up to 100% of your compensations, whichever is less. And if you're older than 50 years of age, you can contribute an additional $6,500 as what's called a catch-up contribution. Now, as an employer, you can make an additional contribution of up to 25% of your compensations after deductions. The exact amount is calculated using tables and worksheets from the IRS. So this is an area where it pays to work with a good tax specialist who can help you maximize your contributions before you're in. The net effect is that you can make contributions of up to $58,000 a year, which is a way bigger allowed amount than a regular 401k and a much bigger tax deduction at the same time. It gets even better. You can opt to make pre-tax contributions, in which case you get a break on your taxes for this year and then pay taxes on your withdrawals after you retire. You also have the option of a solo Roth 401k, which I'm going to talk a little bit more about in a moment. In that case, you pay taxes on the money you contribute in this year, but then you can make your withdrawals completely tax-free. Now, I said that this option is only available if you don't have any employees, but there is one exception, and that is if you have a spouse that works in your company. In that case, he or she can also contribute up to $19,500 plus a $6,500 catch-up if they're over the age of 50, and you as the employer can then make the plan's profit sharing contribution or your spouse of up to 25% of their compensation. Another nice thing about solo 401ks is that they're pretty easy to open. You can set one up with most brokers as long as you have an EIN number, something I talk about a lot on this channel, and you can pick from whatever investments that your broker offers. Full fair warning, if you're doing your business as a side hustle and you're already contributing to a 401k plan with your employer through your day job, these limits are per person, not per plan. So that means that $58,000 goes across all your 401ks, not to each one. So I just wanted to say that. Now, the Roth 401k, I mentioned the Roth 401k a moment ago. So let's dive a little deeper into what that entails. The Roth 401k option has only been available since the start of 2006. And just like the name implies, it carries attributes of the Roth IRA with the 401k. Now, Roth IRA, you don't get a tax break when you contribute to the IRA, but when you withdraw your money is when you receive tax-free income. Unfortunately, the maximum you can contribute to a standard Roth IRA is $6,000 a year or $7,000 if you're over the age of 50. Once you're making over $140,000 as a single filer or over $208,000 as a married filer, you can't contribute to a Roth at all. With a 401k, as we've discussed, you can contribute a lot more per year, meaning more to fund your retirement. And you get a tax break when you contribute to your retirement fund. The downside is that you pay taxes later on in life when you withdraw those funds, and who knows what the tax rates are going to be later on in life. The Roth 401k gives you the best of both worlds. Just like a regular Roth, you don't get a tax break on your contributions. However, you can contribute a lot more. There's no income cap, and the entire balance will be tax-free once you reach retirement age. So, how much can you contribute? Well, if you have a solo Roth 401k, you're following the same contribution rules as the solo 401k, meaning up to $58,000 for 2021. And if you're over 50, then you can contribute that catch up of $6,500 on top of that. Now, there is a little fine print here. In order for your withdrawals to not be taxed, you need to have held the account for a minimum of 5 years. So you don't want to wait too long to set one of these up. You can start withdrawing on an account due to disability or when your account holder is 59 and a half or older. If your company has already a regular 401k plan, it shouldn't cost too much to have your plan administrator add a Roth 401k option. It might even be free. Your plan service provider or custodian should be able to explain your options and help you set it up for you and your employees. Now, let's talk about a SEP IRA. Next up, we have the Simplified Employee Pension Plan, also known as the SEP IRA. SEP IRAs were created to help small business owners provide employer-sponsored retirement plans to both employees and to themselves. Any business owner with one or more employees or anyone with freelance income can open one of these up. They're best though for people who are self-employed or business owners who just have a few employees, because as a business owner, you must contribute on behalf of your employees, and those contributions must be an equal percentage of compensation to your own. So for example, if you want to sock away 10% of your compensation for retirement, you have to also contribute 10% of each employee's compensation to their accounts as well. Whew. The good news is that those contributions, whether you make them for yourself or for your employees, are tax deductible. You also don't have to commit to contributing every single year. So if your business is slow one year, you can adjust your contributions or skip them altogether. For 2021, you can either contribute 25% of compensation, your and your employees, or $58,000, whichever is less. Now, another advantage is that the SEP IRAs are pretty simple and inexpensive to open. They don't come with the startup and operation costs that most 401ks do. Businesses can also receive a tax credit for expenses incurred when establishing a SEP, and they may also be able to deduct plan expenses as well inside of their SEP. SEP IRAs are tax deferred, meaning that as you put money into the SEP IRA, employees will pay taxes on withdrawals, not when they put the money in, and there's no catch-up contribution option if you're over 50. Next, we come to Simple IRA. Simple IRA stands for Savings Incentive Match Plan for Employees. To be eligible for a simple plan, a company has to have 100 or fewer employees, or if you're self-employed or a sole proprietor, you can open the Simple IRA for just yourself. Like SEPs, simples are easy. They're inexpensive to set up, and